Okay, good morning. Get started for continue the chapter 3, adjusting process. So on Monday we covered a few of the adjusting entries. So remember this chapter, the main purpose here, we're trying to bring up some of the accounts to its up-to-date status before we actually do financial statements. Okay, so this is the main purpose of adjusting entries, and there's 5 types of adjusting entries, which on Monday we covered the first 2 already. Okay, so let's just briefly go over the prepaid expenses, depreciation that we covered on Monday already. So remember prepayments, all the prepayments, the money that the cash or any types of checks that corporation paid in advance for certain type of benefits is a type of asset, right? So prepaid expense is an asset account. Remember we went over this journal entry. If this company paid rental expense in advance for 3 months, altogether $3,000, at the end of the first month, when we use up 1 month of benefit, when this part of the benefit is no longer in force, we want to change that into rent expense. Okay, so the prepayment is a type of asset. We turn that $1,000 into rent expense, and at the same time reduce prepaid rent. So reduce an asset account, turn it into a type of expense. So this is the first type of adjustments. For all the prepayments that we made earlier during the accounting period, those journal entries were readily captured here during the process. It's either in the beginning of the month or somewhere in the middle. We want to adjust the part that we already used up. So for example, if it's supplies, we purchased $2,000 worth of supplies in the beginning of the month. At the end of the month, we want to reevaluate how much does it worth, the supplies that we still have in the business. Okay, so in the middle, whatever we have left compared to what we had in the beginning, the differences, we want to adjust it. So if it was supply, then we want to reduce supplies asset by crediting supplies and turn it into supplies expense. Okay, same for insurance. If it's prepaid insurance for certain, let's say for 6 months, and after a month using it, we turn that into insurance expense. Okay, so just recognizing the part that has readily expired that is no longer in force. Now, what is depreciation? Remember, this is a new account that we were trying to measure the value of the long-term asset, specifically the part of the long-term asset that is no longer useful. So this is a measurement that we use in accounting. It's not that this asset really is missing a piece or something, or it's not that we're selling it out to anybody. We're actually just measuring it based on how we use it in the corporation. So the example we went over was the furniture example. Remember, if we purchased an asset originally worth $18,000, as we use this asset in the business, even though it's always there, but we still want to measure that it has gradually been growing old. So we want to decline the value as time goes by. Okay, so this entry here only recognizes a month of using this furniture. Remember, we're just capturing May. So assuming that this furniture has a lifetime for 5 years, then every single month if the company issues monthly statement, we'll be doing this exact same entry all over again. Okay, so we will spread out the cost of $18,000 divided by 60. Every single month, reduce the assets value by $300. So by doing this chapter introduced 2 new accounts. One is depreciation expense. So this account will capture, the debit side will capture the part of the asset that the value that is no longer useful, the part that we want to deduct. And at the same time, we will be crediting accumulated depreciation. So remember, this account is a special account. It's called contra asset account. So all the contra accounts later on in chapter 8 will be introducing, you'll be introduced to other contra accounts. So basically, if it's a contra liability, then it has the opposite direction of the regular liability account. So contra means the opposite. So here's a contra asset account. That means it goes hand in hand with one of the originally purchased asset account. So in this case here, the furniture case, it would be going hand in hand with the furniture account. So you will see on financial statements, you'll see furniture. Under the T accounts is the original historical cost. Then you will see a separate account listing next to it. It's typically below it. We will have the value of the asset that we want to represent as no longer useful. Okay, so contra asset account accumulated depreciation is a deduction account for furniture. Whenever you see any dollar amount there under the accumulated depreciation, then that means the company has owned the asset for some time. They have been using it for a while. And the real value of the asset right now is only $17,700. Okay, so the higher the amount you see under accumulated depreciation, that represents the longer the company has been owning this asset, has been using this asset. So that account will only go up. Later on, you will have another 300 there, another 300 after the third month. It will become 600, 900, 1,200. It will just gradually accumulate. So that at the same time represents the book value of the furniture will gradually be reduced. Okay, so the book value represents the current value of the asset. That is the original purchase price, historical cost. This is the part that we recognize that the value has readily been deducted. Okay, so when we journalize this entry, we'll be, again, debiting depreciation expense, crediting the contra asset account, accumulated depreciation. So this contra account has a normal balance here, the opposite of regular asset. It will be on the credit side. Okay, let's move on to a new type of adjusting entry, accrued expenses. Accrued expenses, remember the term accrued I mentioned on Monday, it represents accumulated. Here, this idea readily we talked about in chapter 2, actually. And in the beginning of this chapter, on Monday, we talked about, remember the example of employee salary? So if you hired a person, an employee, to work for your business, they have been working continuously every single day from Monday to Friday. And if the check is being paid out on a bi-weekly basis, let's say last check was paid out May 15th, and you want to pay out the second check at the beginning of next month. When it reaches the end of the month, we want to recognize the portion of the salary expense that we owe to the employee already. So even though we have not paid out cash, this is an entry that we want to capture, which is called accrued expenses. So it's an accumulated of expenses that company has not yet paid out by cash. So which means at the same time, this generates a type of liability. So it could be accounts payable, it could be salary payable, it could be interest payable. All types of accrued expenses, different types, it could be interest expense. Once you borrow money from others, interest rolls on a timely basis. Okay, so every single day there's accumulated interest, but we wait until right before we want to do financial statements, issue financial statements to capture all of these accumulated expenses. Okay, so the idea here is the opposite of prepayments, because remember prepayments is the fact that we are paying money in advance for a certain benefit for the future. So in that case, you're giving away cash early on. This case here, you have already received benefit from either hiring employee that have been working for you, but you haven't paid the check. So the work is there, or interest expense, you borrow money from others, you have been using the money, but you haven't paid the interest amount. Right? So this is the opposite of prepayments. You're waiting until after the corporation has readily received some sort of benefit or resources, and then you pay the money by cash, pay back the money. Okay, so this is the opposite of prepayment. We wait until after using resources or benefit, then we make the cash payment. Here's a note. Companies do not usually make weekly journal entries for these type of accumulated expenses. We wait until a certain date, and typically that's before we give out financial statements. So by May 31st, or by June 30th, July 31st, company will be clearing some of the entries, making sure that bringing up these accumulated expenses, these prepayments that has been expired, the depreciation expense that has to be recognized all together before financial statements. All right, let's take a look at an example. So if the monthly salary expense for a certain employee is $1,800, and we break that into a bi-weekly check, $900. So when it reaches May 15th, the employee receives the check directly, the $900. So in that case, it will be just a regular salary expense and credit cash. When it reaches the end of the month, in a corporation perspective, they want to issue financial statements, and if it's not the date for giving away check, it's not a cutoff date for check yet, then this entry would represent the part of the work that employees has been doing, but we haven't actually paid out the cash. So it represents salary expense, we debit it, we credit liability. So even though this payment will be made immediately June 1st, it seems like just a day difference. We still make this journal entry to represent a liability for this very same day. Because oftentimes monthly statement only represents information from May 1st all the way to May 31st. So anything that's happening on June 1st will be under June's monthly statement. Okay, so it seems like it's just a day before the actual pay date. You might think we can just defer this. But remember that journal entries, we recognize it as it happens. We want to bring up to date the information. If this monthly statement represents only May's journal entry, then we want to bring all the accounts that represents May's activities. So this account basically represents that there's a personnel that you hired that's working for you. Even though you haven't paid the check, you want to recognize the work that they have done. So this is their work has already been into a type of expense, and later on you will have to pay them this $900. So this entry really will be immediately reversed on June 1st. Once the check is out, then the salary payable will be debited and then cash will be credited. Okay, but that will be later on. By the end of the month, this will be the adjusting entry, May 31st. Now here's another example. If the company earlier borrowed money, let's say $1,000 from a certain company, and assuming that the interest rate is 10% of that, and if that is rolling on a monthly basis, then every single month you'll be recognizing $100 of interest expense. So that's just an example that I gave you. So if that's the case, then by the end of this month, if this is not the date for your corporation to pay back that $1,000 yet, then this will be the interest expense and interest payable that has to be recognized. Okay, payable is always recognized at the point of time when it's not the day to pay the cash yet. That's why we recognize it under liability. Okay, so it's the money that you owe, but it's not the time for paying it out yet. Typically, it's not the due date or not the paid date for the check. So for each and every journal entry, we have two. Remember that whenever you have journal entries occurred, you have to open up the T accounts that represents those journal entries. So you have an interest expense account, interest payable account. Remember, expense is an equity account, and it has a balance on the left side. Equity account regularly is on the right side for revenues, for retained earnings, for common stock. But for expenses and dividends, whenever it incurs, it's on the debit side. A liability account, any type of liability account, as long as it's a regular type, not the contra type, then it will be the regular balance will be listed on the right side whenever it incurs. Okay, if later on if you pay off the liability, then you will debit it, reduce it. Okay, so this is a third type, accumulated expenses. Let's work on an example, a question here. Okay, assume that a weekly payroll for this company is $300, and when it reaches December 31st, the end of the year, this is a day that falls on Tuesday. Okay, so meaning that we want to bring all the accounts up to date, and this is December 31st is Tuesday. We want to also represent an adjusting entry for the work that employees has been doing for this week, Monday and Tuesday. So if this is the case, what will be the journal entry that you will select from these options? So you have to know what are the accounts to use, and also what is the dollar amount. Any thoughts? So if it was a weekly journal entry for salary, then what would be the dollar amount? If it's a regular week. If it's a regular week, it would just be $300, right? For 5 days. Now, it falls on a Tuesday, which means that by the end of the year, we're only trying to, if all the other entries were captured then on a weekly basis already, then this week there was only Monday and Tuesday, and that's it, right? If we want to represent a statement that ends December 31st, we only have Monday, Tuesday left for this adjusting entry process. So if it's only 2 days, if 5 days represents there's $300 for 5 days of work that worth $300, then each and every day worth $60, right? Then 2 days altogether worth $120. So the $120 here, remember this is an adjusting entry. So this is not the day for payment. Payment is given on a weekly basis. Then this is a type of salary payable. This is a type of liability. At the same time, we want to debit salary expense. Okay, so if I change the question here, if I say December 31st falls on a Wednesday, then what would be the dollar amount? 180, right? If it's a Thursday, it'll be $240. But regardless of the dollar amount, this will be the journal entry that we'll be doing. Adjusting entries, remember, we're trying to capture and bring up to date some of the accounts. Okay, otherwise, without this entry, we just have the entry that was being done last week, up to last Friday. So we need this entry that represents this Monday and this Tuesday before we give out the yearly statement or monthly statement. Okay, let's move on. Accrued revenues. So we had accumulated expenses, and now we have a category of accumulated revenues. So really this section of the adjusting entries you already have, for the most part, the knowledge in it. So in Chapter 2, we talked about accounts receivable, remember? Accounts receivable and notes receivable all falls under this category. Basically, it represents the revenue that the company already earned, but they have not yet received cash, and that's all it is. So when it reaches the end of the month, we want to represent, for example, some of the contracts, like if a company hired SmartTouch to perform e-learning services starting from May 15th, and let's say that on a monthly basis they agreed to pay SmartTouch company $800. So this is a monthly contract amount. So from May 15th all the way to the end of May, there has been 2 weeks already. So if SmartTouch company has been providing e-learning services for 2 weeks, even though the regular pay date probably is June 15th next month, so exactly a month later, they should be getting this $800. But by the end of this month, if we want to do monthly statement, we want to represent the work that the company has already provided to clients. Okay, so this is essentially what it means for this journal. We want to represent that we've been providing learning services for 2 weeks already, even though we haven't collected cash from customer. We want to represent accounts receivable and service revenue that we readily earned. Okay, so remember revenue recognition principle. Company always record the journal entries, even though revenue is not yet collected by cash. If the service is provided to a certain degree, if the goods are delivered, then we capture the service revenue. Capture the part even though it's only partial. Okay, so by the end of the month, for monthly statement, we represent 2 weeks of work that we have already, which is worth $400. Okay, so make sure for adjusting entries you have a good idea of when exactly was the beginning point of the contract and when are we trying to do the monthly statement. And what is the time lapse between it? So if the contract was signed in the beginning of May, then it will be fully $800. If it was signed in the beginning of May and the payment will be made June 1st, then this will completely be $800. Okay, but since the contract is from May 15th all the way to the end of May, there has only been 2 weeks, right? So each and every week worth $200 of work, altogether 2 weeks worth $400. Right, so in terms of T accounts, again, we have an accounts receivable account that links to the debit side, service revenue that represents the credit side. So you will see that this dollar amount above represents all the other entries altogether. So we're trying to update this part here. So adding $400 of service revenue. Okay, so again, accrued revenues represents accumulated revenue that corporation readily earned even though they haven't received cash. Okay, accrued expenses represents accumulated expenses that company has already incurred but they haven't paid off the money. Okay, last category here is unearned revenue. Okay, unearned revenue is, again, has a special name, but it doesn't represent revenue. It represents liability. Okay, unearned revenue is a regular liability account. It increases on the right side. So just by its name, unearned revenue, that means the corporation haven't actually provided the goods, haven't actually provided the services, but they have the cash from client and customer on hand already. It's almost like the opposite of accrued revenues. Accrued revenues, the previous case was they have been providing e-learning services continuously. They haven't received the cash from customer. This is the opposite. Corporation could be signing a contract with client. Client readily pay the money in advance. So this, in the corporation's perspective, they have money on hand for the service that they need to provide later on. So they have the cash already, but they haven't provided the services and goods. So later on, when it reaches the end of the month, we want to represent the part of the service that we readily provided. Okay, so this is the opposite of accrued revenues. We collected cash up front now, but then later on, when we provide the services, we want to turn that liability into actual service revenue. But this account itself is a liability. So in the beginning of the year, let's say the beginning of May, I collected cash, the corporation collected cash in advance for 2 months of services. Then in the beginning of May, May 1st, you will have an entry that looks like this. Debit cash, credit unearned revenue for, let's say, $1,000, for example. And this is, for example, worth for 2 months of work. And by the end of this month, when it reaches May 31st, I can represent service revenue for a month already, $500, and reduce the unearned revenue liability by crediting unearned revenue. Okay, so this is the part that we want to do, the adjustments part. We want to turn the liability into service revenue, a certain portion that the company has readily, based on the service and goods that they have readily provided. So let's look at another example. Assume a law firm engages, again, Smart Touch to provide e-learning services, agreeing to pay $600 in advance monthly. So the cash will be received by e-learning Smart Touch company before they actually provide the e-learning service. So earlier, May 21st, you see this entry here, collecting cash, generating a liability account because they haven't actually provided the service, unearned service revenue. So remember, we record journal entries as it happens. Even though we haven't provided the service, since we have cash on today, we need to do something about this, record this in a journal entry. So in this case, it's not a regular service revenue yet, it's a liability. So what happens when it reaches the end of the month? So this $600 is for a month of work. When it reaches the end of the month, it's 10 days later, right? May 31st. So how should we adjust this entry? If it's 10 days later, then would it be $600 that we provided in terms of the value of the service? No, because 600 is for a month worth of service, right? If it's May 31st, it's only 10 days later, so we have 20 more days to go. So for 10 days worth of service, what would be the value for that? It would be $200, a third of 600, right? Assuming that all of these service revenue you can assume is on an equal rate every single day. Okay, so if it's 600 for a month, then you can assume that 10 days later, it's only a third of it, which means it's $200. So we want to turn $200 of liability into actual service revenue because we have been continuously providing e-learning services. Okay, so the adjusting entry here is the second one. First one is the entry that happened in the middle of the period. The adjusting entry here is May 31st, the one we want to make before financial statements. Turn liability into actual service revenue for the part of the work that we have provided to client. Okay, so it's not entirely 600 because that's when it reaches June 21st. Then we fulfill the whole $600. Now it's only 200. We reduce an earned service revenue liability account by debiting this account and then turning the revenue into actual service revenue, just on the credit side. Remember, service revenue is an equity account, regularly, and increases on the credit side. Okay, so for T accounts here, you see that an earned service revenue, if I didn't tell you the whole situation above, if you just look at this T account, you should still be able to understand the information represented here. So if you look at an earned service revenue account, remember this is a liability account. So once you see something under the right side, the credit side, that represents earlier you had altogether liability that worth $600. But now when it reaches May 31st, you reduce this liability by $200. So you still have $400 worth of liability, which represents the liability that is the service that you owe to clients, altogether worth $400. Okay, so later on when it reaches June 21st, when it reaches the month, then you'll be turning that $400, posting this to debit side and turning $400 into service revenue as well. You know, service revenue here, you have all the other entries that relates to service revenue, but this is particularly the one that refers to this unearned service revenue part. Questions so far? Okay, so again, what we're trying to do is making adjustments. These are not the major part of the journal entries. So all the major parts are regularly captured on a daily basis as transaction happens. The adjustments are related to usually some of the journal entries that we readily made before. We want to bring those accounts up to date. Okay, so earlier we journalized this entry. We didn't adjust it. It seems like we haven't provided any type of service to this client at all. So at the end of the month, we want to make adjustments representing that we have been working with clients to providing this type of service or goods. Okay, let's work on a problem here. Finis first gains a client who prepays $540 for a package of. Okay, so if this company collects $540 in advance and will be providing the training later, after first training sessions, what would be reported on income statement? So in the beginning, when the Finis first gains a client, prepays $540, then the entry would look like the entry that we covered earlier. We have cash collected, $540, and we have an unearned service generated because we owe to clients $540 worth of service. Right now, at the end of the month, the company actually provided 4 training sessions. So altogether, this $540 represents 6 training sessions altogether. So which means each training session would worth how much? $90. So $90 for each training session, and we have provided 4 training sessions already. So this will give us $360. So the next question will be, how do we journalize the adjusting entry? Okay, so earlier we have $540. This is liability. And we're turning the $360, which we readily provided, the service that we readily provided, into actual service revenue. Okay, so on income statement, remember it only captures revenues and expenses. You will see, if this is the only entry, then you will see service revenue, under service revenue, a dollar amount, $360. That represents this 4 training sessions that company provided. Okay, so the beginning entry in the middle of the accounting process, it will be collecting cash, generating an earned service revenue liability account. Then later on, we turn that liability, a part of it, into actual service revenue. Any questions? Unearned service revenue, it's a liability account, so that will fall under a balance sheet. Okay, so yes, you will see the unearned service revenue. In the beginning, we have 540, and then later we reduce 360. So you still have about 100. Each training session worth 90. So you have 2 training sessions left. So you will see unearned service revenue under balance sheet, $180. Okay, let's move on. So just a summary of all the adjusting entries. Remember the rules in the beginning, it never involves cash. So all the cash-related entries we already captured before. So while I go over the adjusting entries, you see some of the entries that relates to cash, but that's just representing the ones that we covered earlier. Adjusting entries are the ones that just either increase or decrease the type of revenue or expense account, and then ties to a type of asset and liability, which is not cash account. Okay, so this is an example that the adjusting entry is this part. Earlier we collected the cash, but the adjustments is that we're turning liability into a type of revenue. So for accrued revenue is the same case. If we provide a service to customer, but we haven't collected cash, we still need to make adjustments. If it's accrued expenses, remember that means, an example I gave you was salary expense, salary payable. So again, that doesn't relate to cash account. Prepaid expenses, you readily paid it in advance. The adjustments that we want to make is turn the prepayment asset into some type of expense, rent expense, or insurance expense, the part that has expired. All right, so prepaid expenses, the cash paid in the beginning of the season or in the middle of the accounting cycle, and then we want to expense that asset later, once the part that has already expired, no longer in force. Accrued expenses is incurred first. You have employees working for you, or you have been using, let's say, a location for a while and then you pay rent. So the payment is made later on. Unearned revenue, you have collected cash from customer in the beginning of the season, and later on you turn the part of the liability into actual service revenue. Okay, the opposite would be accrued revenues. Revenue is earned first. You provided the learning service, provided the goods first, then you collect cash. Okay, so then you will have accounts receivable later. So the whole purpose of this, we're trying to properly measure net income for the period of time. So without all these adjustments, some of the accounts will be messed up. It doesn't represent the current status of the business operations. Okay, remember the statements, the main purpose is to provide information for outside users who are not working in the business, who relies on those statements to have an idea of what's going on in the business. So they would not know if you do not journalize these adjusting entries. They don't know whether you have been providing the service, whether you have collected, returned part of the service into, part of the liability into actual service, or you have incurred expenses that you haven't actually paid. Okay, so the whole purpose of doing this is to update some of the accounts, making sure the information we have provided to outsiders is complete.
Did you say that later on there would be revenue becomes service revenue?
You mean this?
Yeah, like what's the process for it? Did you say later on you would go into that?
I mentioned that how this liability will turn into service revenue. So
How does unearned revenue become service revenue? What's the process for it?
well, the process would be actually continuously providing service, like this example. So at the beginning, customer paid you on May 21st, you collected cash from them. Now you're the client, I'm the company. You paid me $600 in advance for a month worth of e-learning service. And let's say that e-learning service goes on Monday through Friday, continuously. Right? So by the time we reach the end of the month, May 31st, there has been 10 days worth of service that readily been provided from me to you. This will be the part of the liability that turns into service revenue. So it will not be the entire 600 because you still have 400 for next month, right? But by the end of this month, we want to represent the part that we actually provided service to you, that we did the part of our work, right? But it's only a portion of that. So that will be the process of turning it into it. Basically, it's going on a timely basis. So as time goes by, you represent the part based on the days. Okay, we're going to do a few examples, have some journal entries examples, and also do the one set of adjusting trials later. So this slide basically summarizes all the adjusting entries that we cover now, the 5 types. So the upper part there you see prepayments, prepaid expenses, an example there is prepaid rent, and then the right side is the adjusting entries for the upper 3. We turn prepaid rent asset into rent expense. Okay, depreciation links to one of the earlier entry when we purchase a long-term asset. Then later on, as we use the asset, we represent depreciation expense, the deduction of the asset's value. The usefulness has been reduced by a certain dollar amount. Okay, so depreciation is debited, accumulated depreciation credited. An earned revenue, remember, corporation collected the cash in advance, then they provide the service. So the part of the service they provide later on, between the time they collected cash and the end of the season, that will be the part that we want to turn into actual service revenue. Okay, so for the upper 3 types, the right-hand side is the adjusting entries with the blue arrows. For these 2, accrued expenses, accrued revenues, these are accumulated expenses and accumulated revenues. Okay, so we have employees working for us. The adjustments at the end of the year will be salary expense, salary payable, the liability that you owe to employee already. Accrued revenue, if you have accumulated, you have already provided service to client, a portion of it, you want to represent the part that it's considered cash received later, accounts receivable. Okay, so these would be the 2 adjustments. These 2 accounts here represents later on. When it reaches, remember, June 1st, we want to pay employees actually the biweekly salary by cash. So that's the time when we turn liability into actual cash payment. Okay, so these 2 are not adjusting entries. The upper 3 and the left side, these 2. When you go back to read the book, you'll see this chart there. Don't confuse yourself. These 2 here are adjusting entries. And the upper 3 on the right-hand side. Okay, anything with cash involved is not adjusting entries. So these are the entries that will happen later on in next season. So the last one here, once we have accounts receivables recorded earlier, we want to turn it into actual cash received when clients pay us the money. Okay, so that will also be an entry that happens later on. This is a table on page 145 of the book. So make sure you mark the ones that are actually adjusting entry. It has the title there, but these 2 really are not. Okay, these 2 are the adjusting entries. Okay, T accounts. Remember journal entries, after we capture them, we always post them to the ledger. The T accounts is just exactly representing the same information, just in an account form. So look at the label there. There's A, B, C, D, E, F listed here. If you look at A, can you tell me what's the information there? You see an A on rent expense, and you see an A under prepaid rent, right? So what does it tell us? The rent has been prepaid earlier, $3,000, and then what happens? Then the $1,000 would be, if 1 month went by, then $1,000 worth of rent expense the prepaid rent has expired, right? So we turn that into rent expense. But yes, earlier we did prepay $3,000. So right now, the asset account originally was debited $3,000. Now we credit $1,000, representing reducing the asset. So we only have $2,000 left of prepaid rent that's still in force. Okay, now what about B entry? You see a B under supplies and a B under supplies expense. So supplies originally, how much did we had in the beginning? $700 worth of supplies, and now we use up 100. So we only have 600 left, and we use up 100 at the same time. This will affect supplies expense account, so that will be debited. Okay, so B represents the entry of prepayment, specifically supplies prepayment, and then we use up a part. All right, next we have C and D. So what is C and D representing there? Depreciation, and specifically this relates to the furniture and building that we purchased earlier. We have furniture, historical costs, we purchased about $18,000. There's building that worth $48,000. Remember, those two amounts will stay there representing the original cost. So as we use this long-term asset, we'll reduce the value of it by listing it depreciation and depreciation expense. So this represents that on a monthly basis, furniture, its usefulness reduced by $300 worth of value, building reduced by $200. Okay, so this again is a monthly recurring entry that will happen on a monthly basis. Now E and F, we have salary payable and also interest payable, interest expense. So what is representing under E? So again, salary payable relates to the employee, the personnel that's working for you. Say you have incurred this salary expense, but you haven't actually paid it out, so it's a type of liability. Interest, you borrow money from others, you haven't actually paid out this interest amount, so it's a type of payable as well. Typically, it's not the due date for that liability. Okay, so it would be debiting interest expense, crediting interest payable. All right, we have service revenue account and earned service revenue and accounts receivable. See service revenue, there's G over there, and the other G is under accounts receivable. So meaning that the company has been providing service but haven't collected a part of the cash that's worth $400. So that's why it's an accounts receivable, cash received later. Unearned service revenue and service revenue tied together, meaning that you have earlier unearned revenue, the liability $600, the cash that you collected in advance, and now you provided $200 worth of service, so at the same time it increases service revenue by $200. Okay, and again, unearned service revenue is a liability account. When you debit it, that means you reduce it. The credit side, 600, represents the earlier we had cash, that was $600 that we collected in advance for this type of service. And then you provide, remember, 10 days of service, you turn $200 into actual service. All right, let's work on a few examples. Okay, you have a better idea how this actually works. So for these transactions, I just want you to identify among the 5 categories of adjusting entries, which ones do these fall under? Okay, just the title. So paid 6 months of rent, $4,800. Which category would that fall under? Meaning if earlier, April 1st, we paid 6 months of rent, by the end of this month, we will have to do rent expense, prepaid rent, so that will be under prepayments, right? Prepaid expenses, the first category of adjusting entries. That's correct. April 10th, received $1,200 from the customer for a 6-month service contract that began April 1st. So you're collecting a bunch of money in advance from customer, meaning later on you will have to turn that part of liability into actual service revenue. So this will be under the category of unearned revenue, exactly, to collect cash in advance. Okay, April 15th, the company purchased computer for $1,000. Computer is considered a long-term asset as well. Okay, so what do we have to do about this? $1,000 later on we will need to, it's long-term asset, and that means as we use it, we want to represent later on the part of the value that has been reduced. So this will be under depreciation category. These blue lines represents the adjustments that need to be made because of these journal entries that happened before. All right, there's a few more. April 18th, we purchased $300 of office supplies. So what happens at the end of the month? At the end of the month, we want to know whether or not we still have $300 worth of supplies, right? So this again is considered prepayments. We purchase supplies, and later on we want to identify the part of the supplies that we used up. So if at the end of the month we only have, let's say, $50 worth of supplies, then that means we used up $250. So that turns into supplies expense. We reduce supplies. Okay, work performed but not yet billed to customer. Which category would this fall under? Work performed, but you haven't billed customer, meaning you haven't collected the cash, but you provided the work. You provided the work, so that will be an accumulated revenue, okay, accrued revenues, meaning you will be using the accounts receivable, right? This is the same as saying providing services on account. You haven't collected cash. This is the same as saying providing service on account. Okay, the last one here, employees earn $600 in salary that will be paid later May 2nd. So when it reaches April 30th, we want to record this $600 under salary expense and salary payable, an accumulated expense. It's a type of liability now. Later on, actual cash payment when it reaches May 2nd. Good, you have been following. Are able to answer them. Yes, that will be the first one here, April 18th. How? So it's because supplies you purchase it oftentimes is in advance for the usage of a certain time period. So we'll be identifying the supplies that we collected, that we purchased earlier, and as we use it later on, when it reaches the end of the month, we reevaluate what's the value there. So if there is a difference in between, then that means we have been using this asset all along. So we turn that into expenses, which means that we use it up. So the idea of expense is the part of the resources that we use up that's necessary to support the operations, right? To support revenue side. Okay, so supplies, the value, whenever you see supplies purchases, it's under supplies account, but the idea there is like a prepayment because you purchase it in advance, usually all together, and then later on. But we don't record this as we use a piece of paper or as we use a pen or pencil. We record it later on when it reaches the end of the month. Okay, just look at it all together. What's the part that we used up? Okay. Okay, let's do a few more exercises. Okay, now try to journalize this. Okay, besides identifying the category, try to find a piece of paper and identify the account debits and credits for A, B, C, D, E situations. How would you journalize the entries? Okay, including the dollar amount. Be careful whether it's the original dollar amount or is it only a portion of it. So it says that we want to journalize entry for January 31st. Okay, for the first three entries here, we have depreciation, $500, prepaid rent that expired, $600, interest expense accrued. So for depreciation, even though it hasn't, supposedly the problem should be telling you even more detailed information on which type of asset they're referring to. Okay, but for simplicity purposes, this is a simpler exercise. You just have to list depreciation expense and accumulated depreciation. If it specifies which type of asset, usually under accumulated depreciation, you have a slash furniture, a slash building. Okay, for different types of asset, you have a different accumulated depreciation account, and also a different accumulated depreciation account. Okay, for this problem specifically, you just have to identify debit side is depreciation expense, regardless of what type of asset it will be under. When we depreciate it, it will be debited by depreciation expense, credited by accumulated depreciation. So again, accumulated account is a contra asset account. Okay, reduces assets value. Fee prepayment, the rent expired, so meaning that earlier we had a prepayment before and now a part of it is no longer useful. It has expired, it's no longer in force. So we reduce prepaid rent, an asset account, and turn that into rent expense, $600. The interest expense, the reason why there's an interest expense accumulated, that links to what type of money that you borrowed or lent from other corporations. So you have interest rolled based on time. As time goes by, there's interest rolling. So we would accumulate $300 and want to capture this before we give out financial statements. Okay, so debit side interest expense, credit side interest payable, $300. Okay, so now oftentimes the numbers will be given to you, but like in chapter 8, we'll actually be going over how to calculate this when we borrow money. But here, whatever is the dollar amount given to you, as long as you make sure it's this period of time, then you just capture this here directly. Okay, we have two more. Employee salaries owed for Monday through Thursday. And this is a five-day work week, but we're only capturing Monday, Tuesday, Wednesday, Thursday. So meaning that we're not actually recording payable liability for an entire $13,000, but we break that down to a daily basis and you time it by 4 days. Okay, every single day the work worth $2,600, and you have Monday, Tuesday, Wednesday, Thursday, that times 4 days. So salary payable altogether will be $10,400 instead of 5 days, $13,000. Okay, so if it was only for Monday and Tuesday, then that would be $5,200, $2,600 times 2. But here, we're recording it typically if the end of the month falls on a Thursday, then we'll record 4 days. If it falls on a Wednesday, then we'll record 3 days. And earned service revenue, now we earned it, $1,300. Where earlier we collected money from customer already, and now we provided part of the service that worth $1,300. So liability and earned service revenue will be reduced, and we increase service revenue. That'll be the last one. Any questions for this exercise? Now after these journal entries, these adjusting entries has been made, at the end we want to get to an adjusted trial balance. So we talked about a trial balance in chapter 2. Remember, it captures the majority part of the journal entries, and after we post into T accounts, the balance goes into trial balance. After we do adjusting entries, then the up-to-date account balance will go into an adjusted trial balance. Okay, so the next part of this chapter will be we're actually going over how to actually complete adjusted trial balance based on these adjusting entries that we have done. So the process is really similar. We do the adjusting entries, journal entries, we post them to the T accounts, update the T accounts, then we have an updated balance for some of the accounts. we use the updated balance for adjusted trial balance sheet. Okay, again, this is an internal document that is not yet given out to corporations or users of financial statements. We only wait until financial statements. Okay, I forgot there's another question here. So if we have, after doing the journal entries, the overall overstatement and understatement for net income, this question asks you if we forgot to do adjusting entries, if we omitted these journal entries, what will be the effect to the financial that later on will be disclosed. So this effect here for net income, since it's asking you what's the effect toward net income statement only, we'll just be looking at the expense and revenues account. So for example, first three entries here, you have depreciation expense account, $500. Second, you have rent expense, $600. Third, you have interest expense, $300. All of these supposedly will go into the income statement. But if we omit these entries, then you will be missing $500, you'll be missing $600 on income statement, you'll be missing $300 of expense. So this is the first. Then we also add in the second two, we will be missing $10,400 of expenses. And for revenue account, we'll be missing $1,300 if we did not journalize all these adjustment entries. Okay, so the overall effect, you'll be adding up all the expenses, rent expense, insurance expense, salary expenses, and also the prepayment. Now, revenue part, we have $1,300. So altogether, expenses effect, if we didn't journalize these entries, the expenses listed on income statement will be too less. We still have $11,800 that we missed it if we didn't journalize these adjusting entries. For revenue, we'll be also missing $1,300. So overall, the effect is expenses more than revenue. Overall, the effect will be missing the expenses that are worth $10,500. Okay, so without these adjustments, if we omit these, then the original net income amount that we see under the unadjusted balance would be overstated by $10,500. Because in reality, we have rent expense that we used up. We have interest expense that we incurred. There's salary expense, so we still need to take into account all of those. So without those adjustments altogether, the original unadjusted trial balance will be missing $10,500. Okay, this question is only asking about income statement effect, net income effects. If it were, it's asking about assets effects, liability effects. You'll be going over these entries to take a look at which ones relates to asset. So for example, prepaid rent will relate to asset. Without this journal entry, prepaid rent will be too high. Supposedly it should be $600 less. Okay, or accumulated depreciation, you'll be missing $500. So it will be too much listed there. You have actually been using a certain type of long-term asset. You should be reducing the dollar amount. Okay, so this question is asking about income, net income amount, so you just look at revenues and expenses. Okay, let's move on to adjusted trial balance. So this is prepared after adjusting entries are posted to T accounts, posted to Ledger. And it's a part of the worksheet. In Chapter 4, we'll be going over the complete worksheet. Some of the companies will do a complete worksheet before they get to financial statements. Others may just be doing adjusted trial balance and then use it to complete the entire financial statements. So there are two ways to do it. In Chapter 4, we introduced a more comprehensive way. After the entire worksheet is done, then they do the official financial statements. With companies may just be following this chapter at the end of adjusted trial balance, then they use the information to prepare financial statements quickly. Okay, but this is a column in the worksheet called adjusted trial balance after making the adjusting entries. So this compared trial balance, really the only difference is just the adjusting entries that we did earlier, the 5 types. Okay, so we'll just be updating trial balance by all the adjusting entries that we made, and that's it. Updating that, you will have a new balance for adjusted trial balance. Okay, if we take a look at what a adjusted trial balance will look like starting from the beginning. From the beginning, the left side you will have the original, this blue headed here on top of it is trial balance, the unadjusted one. So if this is the original trial balance, after we make the A, B, C, D, E, F adjusting entries, we'll be posting the information here. You have it in T accounts and then you copy the balance here. So A here, if we just go over a few of them, really is the same entries that we covered earlier. You have prepaid rent earlier, $1,000 that you want to turn into rent expense. Okay, if it's B letter, then it will be using supplies and turn the supplies $100 into supplies expense. Okay, for C is depreciation expense, you will see the other side under accumulated depreciation. So these are exactly the balance that you see for each and every journal. After you post it into Ledger, copy the information here. Okay, it's no different from the journal entries debit credit side. It's exactly the same information. Now after this, how we get to adjusted trial balance, we'll be adding or subtracting some of the dollar amounts that we made adjustments from. So some of the accounts, if you don't see any adjustments, then you just copy the same dollar amount as it is. So for example, cash. Cash, we didn't have any effects. Remember, adjusting entries do not affect cash account, so you just copy 4,800 there to adjust a trial balance. That will be an example of having the same amount before and after. Now, the ones that we need to adjust is the ones that you see A, B, C, D, E, F, G letter next to it. So for example, accounts receivable, you have $2,200 the debit side in the beginning, then you have another debit amount. So you increase accounts receivable by $400. So you see the right-hand side, there's a balance, $2,600. Okay, the following account supplies, originally we have $700, and now you see a credit side of supplies, which means you want to reduce the balance into $600. Okay, so for all the asset account, the original balance you see on the debit side, but during the adjustments, if you see the balance under the credit side, then you have to minus it, reduce it. So another example would be prepaid rent. You have $3,000 in the beginning, then you have an A letter journal entry, you minus $1,000. At the end, the adjusted amount will be $2,000. Okay, now for accumulated depreciation, originally we didn't have anything listed because this is an adjustment that we just did. You just copy the 300, 200 to the right side. Okay, for liability account, remember the normal balance is the credit side. So you see accounts payable listed 18,200 there. We just copy the same information since there's no adjustments made. For salary payable, $900 and $100. This is the new adjustments that we made, so copy the information. Now what about unearned service revenue listed there? So unearned service revenue is a liability. Originally we have $600. Now you see a $200 there. We will need to add or minus that amount. $600 was the original balance on the credit side, and now you see $200 under the debit side. So debit liability would be reducing the liability. Right, so $600 credit is a plus, $200 is a minus. So under the adjusted version, you would see $400 there. That will be the new balance after adjusting entries. You only owe service to customer that worth $400. Okay, now all the remaining accounts are pretty much just copying the same information there. Now we see service revenue. Originally there's $7,000, and now there's additional $400 and $200. So the new balance will be $7,600. Okay, salary expense. Originally there's $900 listed. Now an additional recognition of $900. So altogether there's $1,800. So really what we're doing here is just adding or subtracting some of the adjustments that we made based on the debit credit rule. Okay, so this part also has debit credit rule. If the assets account originally balances debit side, the adjustment is credit, then you reduce it, you subtract it. If the adjustment is also on the debit side, like accounts receivable, then you add it. Okay, liability account, normal balance is the credit side. The adjustment, if it's made under the debit side, like an earned service revenue, then you have to reduce it. If it's again the credit side, then you add to it. Okay, revenue, when you have new revenue received, an earned revenue When you have actually earned additional revenue here, the 400, 200, you add to it, okay, because it's under the credit side. Okay, let's do a quick exercise. I'm going to give you the adjusted trial balance and also the practice questions. All right, for this problem here, it tells you that year-end data includes supplies on hand, $300, depreciation, accrued interest, $600. These are the only three entries that needs to be addressed. Okay, so if you summarize it here on the left side, supplies on hand, meaning that currently we have $300 worth of supplies. So that's a hint telling you that that isn't a readily adjusted amount. Under supplies, you would see 300 left. So what will be there under the adjustments? Okay, depreciation, you will have to reduce dollar amount by 1,000. Accrued interest expense, we accumulated interest expense $600. So these are the three adjustments. Try to see if you can figure out where to post these dollar amount. Okay, now if you can, also do the accumulated dollar amount on the right side, adjust to trial balance. Okay, now for supplies adjustments here, if it tells you that there's supplies on hand $300 and originally you see supplies under the debit side $900, then that means in the middle of this we have actually used $600 worth of supplies. Okay, so for all the three entries here, really the tricky one here is supplies. Supplies tells you what's the leftover that you have now. So it goes back, you have to trace back what is the part that we have to use up. So earlier the questions already tell you what is the part that we use up. Now this problem here, the question gives you the supplies that you have on hand and try to figure out what's the part that you use up. So if there's the $600 that you use up, then you reduce supplies by $600 and debit supplies expense. Okay, for depreciation, it's just like a regular depreciation entry. We'll be debiting depreciation expense, crediting accumulated depreciation. Okay, all of these will be done in a journal entry form, post to T accounts, and then T accounts balance, you copy it here. So we're doing a shortcut here, just directly putting the dollar amount here under adjustments. Our accrued interest expense, that means we have accumulated interest expense that we haven't paid by cash. So the left side will be debit interest expense, and then the credit side will be interest payable. So if these are only the three adjustments that we need to make, then that means under the adjusted trial balance column, these will only be the 6 lines that will need to change the numbers. So meaning cash, we just copy the same information. Accounts payable, the same one. If we go into supplies, you see 900 and you minus 600. You get 300 left. Okay, equipment, copy the information. Accumulated depreciation altogether, you have 2,000 now. Interest payable, $600 since we didn't have any in the beginning. Supplies expense, 600. Depreciation, 1,000. Interest expense, you need to add the original dollar. Okay, so adjusted trial balance, really we're just doing adjustments for the adjusting entries that we made. All the other accounts, just copy the same information and paste it over there. Okay, that will be the end of today. Make sure you go back to review adjusted trial balance. And from this to income statement to the statements, just go back to chapter 1 again. Look at what are the accounts that falls into financial statements. So it's exactly the same process. Income statement first, retained earnings, and then balance sheet. Okay, from adjusted trial balance here.